Welcome traders and creators. In today's video, we're going to talk about how you can predict when the market is about to take off, enabling you to make a massive amount of pips, which result in a massive amount of profits. But before we get into that, I want to make sure you guys are subscribed to the YouTube channel and also follow the Instagram for more Forex videos like this and daily Forex content, trade tips, and tricks. So into the video. So how could you, in this gray box, if you see down here, how could you have possibly predicted this massive uprise in the market, potentially bagging you about 400 to 500 pips? Well, in today's video, I'm going to show you exactly how we can go on lower time frames and predict the movement of the market structure. So we're on gold right now on the hourly time frame. And when you're looking at something like this, it may seem like it's just an uptrend, a consolidation, and then back up. But if we come on to lower time frames, I'll explain to you exactly how you could have capitalized on this setup. So now we're still on gold, 15-minute time frame. I'm going to take this gray box away and break down what happened in this trade. So now that we're on the 15-minute time frame, we get a little bit more data that we can actually work with. And what we're seeing here is that once the market was rising, and we hit that consolidation zone, which is, I'm going to mark off by this gray zone, we can see that the markets just stopped moving, right? The market came up and then came down, and then came up and down and consolidated in this gray area until finally, outside of this gray box, we had a higher high breaking these past highs, basically confirming that we are still in that uptrend. So now that we know that, we need to realize, how does big money play? Because this all goes back to the psychology of trading. You need to understand that in these markets there are bigger players, more so than you and I. These are people like the banks, like Citibank, JP Morgan, Chase, Deutsche Bank. There are billion-dollar players in this bank, and the only way that they can make money is by taking money from retail traders. So when retail traders see a breakout of some sorts, what they're going to do is they're going to set their stop losses and sells above the highs. And so what happens is we have retail stop losses right here. And what happens is the market movers, makers, manipulators, whatever you want to call them, they push the market up, sweeping all of those stop losses from all those sellers. Once those are swept, then as above, so below, you have to ask yourself, where are retail stop losses being placed? Because in this consolidation zone, you know there are breakout traders and retest traders, because that's basically 95% of the retail traders. They play on support and resistance lines, and the big banks understand this, and so they are aiming for stop losses. And so where do you think these stop losses are? Well, these stop losses under equal lows, lower lows, things like that. And so what these banks do is they play on the education of the retail traders. And so after sweeping the highs right here, you realize there are no more sellers, so the selling power all goes to the banks, pushing it down, pushing it down, pushing it down. And what we have right here is what we call an FU candle. Basically, an FU candle is a candle created by banks in order to push price in a certain direction. As you can see, after these highs were swept, 15 minutes later, we have a massive bearish engulfing going where? The lowest part of this wick sweeps these lows, these lows, these lows, these, and these. And all of these lows, how many retail stop losses do you think there were? Once this low is swept, then the market reverses to the upside. But it has to come back to mitigate out. And what I mean by that is the banks were selling within this candle. They had sell positions all throughout here and all the way down. And so since the banks want to push the market up, they have to get out of their sell positions. And so what happens is they need to get out of their sell positions. So we need to come back into this gray zone so they can mitigate out of their trades and then push the market back up. Hence, why you could have possibly entered in this area and then taken this trade for a ride of possibly 400 to 500 pips, while your risk could have only been, let's say you took it from here, maybe 60 to 50 pips. So if you guys like this video, make sure to leave that love, make sure to subscribe down below. We're putting content out like this every day. Make sure to go follow this on YouTube and Instagram. If you guys like this video, definitely stay tuned for more to come.